Good afternoon, everyone. Welcome to HNB's third quarter update call. Today I have here with me our Chief Growth Officer, Bimal Pereira, and our Chief Financial Officer, Anuradhi Dalage. So let me quickly take you through our third quarter performance before we take you into or move into Q&A. So as you know, interest rates or PLR, which was around 12% at the beginning of the year, started moving down gradually and has stabilized around 9% levels. So with this, the entire industry saw the demand for credit picking up. So with this, we saw our gross loans also growing by about 6.2% during the 9 months. But it's, I think, noteworthy to mention that in the first quarter, we saw our book contracting. But since then, from April up to September 2024, we've seen about 90 billion rupee growth in our loan book. So while the loan book grew during the 9 months, in line with the drop in interest rates that we saw, with PLR on average dropping by about 50% during the 9 months of 2024 compared to the 9 months of 2023, we saw interest income dropping by about 24% to 179 million in the 9 months. Our deposit book got repriced. And then we saw a 30% drop in our interest expenses, and this 30% drop was supported by the growth in our CASA book. So when our deposits grew by about 41 billion, this 41 billion was impacted by the appreciation of the rupee also. But with 40 billion increase in total book, we saw CASA growing by 80 billion in the 9 months. So in effect, our NII was at 78 billion for the 9 months with a 16% drop year on year. Moving on, our net fee income grew by 12%. I think compared to the industry, this is a quite stable growth that we've seen. So the key contributors towards this fee income was the cards income and the digital income that we've seen. So on top of that, what we saw was that the insurance income coming from our subsidiary, HNB Assurance, was also seen almost a 20% growth in insurance premium. So the negative that you see here is the exchange loss that we see because of the currency appreciation and the impact it has on the foreign currency reserves of the bank. So in effect, the NII, which was at 15% drop, came down to 8% at a TOI level, and the TOI was 105 billion for the 9 months. Impairment for the year in total was 4.3 billion compared to the 33 billion that we saw in 2023. So this 33 billion in 2023 included 26 billion on account of impairment on ISPs. So coming into 2024, the provision cover that we had for ISPs at 52% was maintained. But for any accrued interest, we've taken additional impairment. With the improvement in the economic environment in the country, what we saw was that the bucket movements also has been quite positive for loans and advances. So with this, the impairment on loans has also reduced, so resulting in a significant drop in our impairment. But having said that, asset quality ratios in terms of stage 3 ratio and stage 3 coverage ratio stands quite strong against the industry levels, with the net stage 3 at 3.3% compared to 4% as at end of first half of this year, and the stage 3 coverage at a 60%. Operating expenses all in all increased by about 15% during the 9 months. So partly this was driven by the increase in personnel cost. So this year is a collective agreement year for HNB. So as a result, we've seen a 17% increase in personnel costs. Insurance costs for HNB assurance has increased by about 12%, with other expenses being managed at a 15%. So with this 15% increase that we've seen in operating expenses and interest income coming down compared to last year, with especially with the interest rates drop, we've seen a cost to income ratio increasing from the levels that we saw last year. So last year levels were at, I think, exceptional low levels because we saw significant or exceptional growth in TOI in the last year. So we've seen this increasing as a result of this. So moving on, at a group PAT level, HNB group was at a 23.7 billion, which is a 25% increase year on year. Tax levels actually remained almost same at or slightly higher. This is mainly because of the ISP impact being lower in 24 compared to the previous year. So this is the snapshot of our profitability. Moving on to the indicators, the key indicators for HNB. I think our indicators in terms of liquidity, capital has continued to remain quite stable right throughout. Our liquidity levels against a 100% requirement is almost at 300% at both LKR and all currency levels. And our capital adequacy ratio, the tier 1 ratio against a 9.5% requirement is at 15.5%, which is 600 basis points above the requirement. And total capital ratio is one of the highest in the industry at 20% against the 13.5 requirement. So quickly moving on to the DuPont, you can see with the rates coming down, net interest income or the margins which were at a higher level last year has got normalized and being around 5% in 24. Other income has seen a slight improvement, which is quite positive. And we see the significant drop in impairment that has supported us. So all in all, what we see is that our ROA has improved from 1.3 to 1.5%, with ROE moving from 12.5 to 13.8. So these are some of the awards or recognitions we got in 2024. I'm not going to go into the details of these. What I would like to highlight is at a bank level, at vertical level, we've been recognized locally and internationally. So this brings us to the end of our presentation. Now I would like to open up for any questions that you may have.
Let me take a crack at this question on the loan book growth expectations. Of course, we are in the last quarter. Generally, we see stronger demand coming into the fourth quarter. Being the year end being December, all the banks try to finish strongly in the last quarter. So that is expected in the 4Q. Of course, going into the new year 2025, we are of course very hopeful, optimistic about the growth prospects of the country. We think the stable macro environment will lay the foundation for strong credit growth. HNB is well positioned given our strong capital, strong balance sheet, lower, lower NPLs or the best asset quality, to support the growth and the credit demand coming from the industries, SMEs. So we are looking for, double-digit growth next year on across all our business verticals.
In terms of stage 2 write back, the reduction in the stage 2 impairment provisions during the quarter. So basically it's through the stage improvements in the staging. So based on the customers repaying whoever who was there in the stage 2, coming out of stage 2, as well as the curing in terms of the proactive restructuring we've carried out, that has caused the sort of reduction in stage 2 impairments during the quarter.
So there's a question again on the outlook for credit growth. As I said, we are looking for a very positive year in terms of credit growth. Come 2025, we've had several years of modest growth, even a negative growth, but the macro environment suggests we are actually heading into a year with decent credit growth coming from all business verticals. So, I wouldn't be surprised if the private sector credit growth, records in high teens for next year.
In terms of the OCI, the portfolio shifting portfolio from OCI to amortized cost, basically we not sold any of the OCI investments, but there had been a shift because as when investments get matured and reinvestment would be at amortized cost, but that is where we are sure of not intending to raid on those things and where we would want to hold those to maturity. So in that from that angle only the shift has taken place.
So there's a question on the expectations on market interest rates and also on HNB's NIMs going forward. So market expectation, of course, again, the fundamentals suggest that the interest rates, at least in the medium term, will remain stable. The outcome of the monetary policy meeting, I wouldn't want to predict that. But, given the very low inflation, stable exchange, and then lesser borrowing demands coming from the state, we expect the treasury bill auctions to result a bullish outcome towards in terms of rates, which will set a marker where the rates are going to be for next year. So we don't expect a major movement from where the rates are. At the moment, the trajectory will remain, and that is the expectation for at least for 2025.
There is this question on long-term, the drive for long-term loans. So what we've seen in the past is that the demand has come mainly for working capital and the investments have been halted. So going forward, what we expect is that most of the industries which did not really go into investments last few years, looking at these investments. So we expect industries like tourism, which hasn't really gone into renovations for so many years. Looking at long-term investments, we expect, I think, most of the industries like manufacturing, healthcare, trading, all of them to basically move into long-term investments to expand their capacities. So there is a question on FD rates being updated on the website. So as and when the rates are basically changed or we take an internal decision to change the rates, those get communicated and we update the site. So this means that we have not updated or changed our rates since September.
So in terms of potential for impairment reversals, yes, I mean, we do focus on reversing, as in improving the quality of the portfolio. And we want our customers to proactively help our customers to come out of any payment difficulties that they're facing. So with their general economy or economic conditions are also improving, we see there's potential for impairment reversals. But we'll be looking at it, taking a very cautious approach towards it.
So the mix on T-bills to T-bonds, we have about 2/3 on T-bills and the balance on T-bonds. So this has gradually, the T-bond portfolio has gradually increased over the last few months or last year, I would say.
So on the ISP restructure, it was announced the intention, the exchange was announced today. So we are yet to assess the impact based on all the exact features that would have come out of the document from the announcement. But in terms of deferred tax asset, so there's no conclusion as yet, but we are pursuing our discussions on it.
There's this question on gross loan book composition. So out of our loan book, we have roughly around 70% under variable terms, and the 30% is on fixed terms. Yeah, the question on single borrower limit. So with the single borrower limit changing from where it is right now from 30% of total capital to 25% of tier 1 capital, there will be a few customers who would be impacted by this change. And the bank is already in discussion with these customers as to how we plan out.
Hey,
Because
Reshmi, Anjula.
hello, is there any question? So we are in discussion with these customers to basically plan out as to how we go, because we have time up until 2029 to gradually move these customers.
In terms of ISB, the provisioning impact, any reversals to come, we are yet to assess the impact, as I mentioned before, and we'll be having discussions with CA as well, CA Sri Lanka as well, and our auditors. So after those discussions, only the final impact could be assessed. So we are yet to come to that stage at this moment. So on stage 3 provisioning, yes, we've seen the industry, there had been an increase in the stage 3 provisions and the provision coverage has improved. So I guess it would be on a more proactive basis, would need to increase the covers for specific customers or as on prudential grounds. So apart from that, it's basically driven by the fact that when there are improvements in the overall general economy, generally the impairment is tend to come down. But on a specific case by case basis, there may be need to increase the overall provision levels for certain specific customers. So that would have driven the increase in the stage 3 coverage.
So there is a question on our proposed transaction in Bangladesh, acquire the Bank Alpana's business in Bangladesh. So the current status of the transaction is, as you are aware, we issued a non-binding offer, and that offer was accepted. And then the next step was to get the clearance from the regulators in both Bangladesh and in Pakistan to start the due diligence. And as of mid-November, we managed to secure the clearance from both State Bank of Pakistan and Bangladesh Bank, giving clearance to HNB to start due diligence on Bank Alpala operations in Bangladesh. So we are on the verge of awarding the due diligence contracts and starting the due diligence work. And so that's the current status, and we will proceed with the plans and try to conclude the due diligence. We are moving into December, the holiday season, so we'll try to conclude the due diligence as quickly as possible, and then we'll move on to the next step, which would be of issuing a binding offer with the approval of the local regulator, that is Central Bank. So there's a question about the new Banking Act and whether HNB would be keen to acquire an NBFI. The answer at the moment, would be no. HNB already has a subsidiary, which is HNB Finance. We hold 51% voting rights, and we will try to extend our SME proposition, microfinance proposition through our NBFI arm. And we have right now no plans to add another company to our group.
On top of that, I think in terms of micro SME within the bank also, we are quite strong. So that's a focus area for the bank as well going forward.
There's a question on CASA ratio. Of course, we've done well as a bank over the last 9 months to improve our CASA ratio, especially on the LKR side. We haven't seen the same traction coming on FCY or foreign currency side, but on LKR we've done really well. I think we've had one of the best years in terms of adding LKR CASA to our base. But the focus will remain even going into the new year to consolidate the gains and build on that. We feel, given the current interest rate trajectory, the lending rates could be under pressure even in 2025. So to maintain our margins, we will work on a sustainable CASA strategy that will complement our cost of funds, and we will be, put us in a position where we can be very competitive with our lending.
So there's a question on microfinance sector. So I think with the economic situation, I think the NPA levels of the entire microfinance sector has gone up. So what we can comment about is our NBFI subsidiary, which has a microfinance portion in it. So at HNB Finance also, they saw their NPAs going up, but on the positive side, what we see is that though their legacy portfolio asset quality is quite high, their new loans, which they have given during the year, their NPA levels are extremely low there. So the sector is actually coming out, or our subsidiary has actually done quite well despite the economic situation. And I think the improvement has actually helped the company.
So there's a question on vehicle import demand, and we are seeing early signs of demand. So it's too early. I mean, we haven't, I mean, I'm not so sure we have seen any NCs being open for public or passenger vehicles. Of course, there is that expectation that this ban would be lifted somewhere early next year. And hopefully we will see more traction when government announces its plans. So far, we haven't seen, I think it's still early days, but given the market has been closed for close to 5 years, the pent-up demand will see robust, demand in at least going into the first half, if and when the ban is removed, early part of next year.
There's a question on worker remittances. So roughly we have about a 13% market share in terms of remittances, and there's a lot of focus on improving this share. So we have representatives in certain countries. We are looking at new partnerships in different corridors. So there's a lot of focus on improving this share going forward.
So there are two questions. I'll take both of them together. On equity transaction, I think we made market announcements to this effect as well. So the HNB Group, being one of the JV partners, together with DFCC, so we announced our plans to acquire the 50% stake of DFCC, and it was subject to regulatory clearances, and also the two parties signing a definitive sale and purchase agreement. And although we managed to secure the necessary approvals, the two JV parties could not come to full agreement on the terms and conditions governing the sales and purchase agreement. So which is where the two parties mutually decided that we would not proceed with the proposed transaction. So that's where it stands. And we will continue to look for opportunities and explore where within the local market as well as overseas opportunities to acquire assets that are aligned with our growth objectives. So that will continue to happen. But as far as equity is concerned, that is where the transaction stands at the moment.
There's a question on credit card income. So credit card income continues to be one of the key drivers of fee income, contributing about, I think, good 30% of our total fees. We have seen a trend, I think, despite how the country situation was, what we've seen is that people have used their cards for transactions, and they have continued to settle also, so that they will have the balance for the next month. I think this was a behavior that we saw over the past few months or so. So we've seen good settlement and good growth in transactions, and we expect the transaction levels to increase going forward.
So there is another question on the expectations for credit growth in 2025. So at least for the private credit growth, we expect there will be over 100 billion a month, or between 150 billion credit growth on average. Those numbers are already seen for the last quarter. If you see, I think the figures in August from Central Bank, the private sector credit growth had been over 100 billion. So, I mean, we are quite hopeful. We will see on average at least 100 to 150 billion credit demand come from the private sector. So there's another general question on exchange rates. Obviously, we are seeing a lot of stability on the exchange rate dollar rupee side, and we do not see any variables at the moment or in the horizon that will upset this equilibrium. We pretty much past the seasonal import demand now, and we are entering the December holiday season where you traditionally see higher inflows from migrant worker remittances, and then also you are entering the peak tourism season. Unless the import volumes, go a couple of notches higher, which would put a pressure on the BOP. We right now don't see a lot of pressure on the dollar rupee. So we expect the dollar to trade around these levels. So, maybe 10 rupees up and down in a very narrow band, at least into the next couple of quarters.
So there's a question about HNB Assurance. So as you know, HNB Assurance has its own general insurance company. These two companies, if you look at it over the past, let's say 3 years, has been outpacing industry growth, has been growing at very high levels. Both businesses have done well. There are two young CEOs driving these two businesses, and there is a lot of focus on aggressively driving both businesses. So, for example, I think there's a lot of synergy between HNB and HNB Assurance. The teams are working together in driving the bank assurance business as well. Similarly, they are working with, they're using technology. They have upgraded their technology also recently, and working on lot of new initiatives on driving their business. So there's a question on leasing, the difference between leasing that we do and what we do through HNB Finance. So if you look at HNB and HNB Finance, we have a corporate EC SME micro businesses, and the original business of HNB Finance used to be microfinance business, which was about a notch below the microfinance segment that HNB caters to. So with what happened in the economic environment, HNB Finance kind of moved from their microfinance portfolio into SME as well. So the leasing that is done at HNB Finance relates to their micro leases and their SME. So I would say the market segment that is catered to by HNB Finance is slightly below what HNB caters to. So the journey is how you basically help these customers at HNB Finance to migrate, improve their operations and migrate to higher level and come to HNB.
So there's another question on Bank Alphala transaction. As I mentioned, so it is still at very early stage. We are starting due diligence. The non-binding offer was a entry into the negotiation table. So the due diligence will take its own time. Assuming the two parties can agree on the binding offer, then there is a lot of regulatory clearance approvals that we will have to seek before we finally conclude the transaction. So we are hopeful. If we can agree on the final price, we should be able to conclude the transaction next year. If everything goes according to plan, maybe by third quarter. That's the best case scenario. So on the ROE, so there's a question on ROE expectations and the challenges. So yes, so our objective is to deliver at least in mid-teens an ROE to our shareholder. And in terms of challenges, of course, we are entering into a period where the high yielding assets and high yielding investments portfolios, that's not no longer going to be the case going forward. We're going to see stable, low interest rates given the low inflation and government's lower borrowing needs, which also means lower yield on government securities. So, in that low yielding environment, how you manage your cost base and still deliver a decent ROE. So that's going to be the challenge, and also to keep your cost under control. So the expectation is, that we will be able to deliver, ROE in the mid-teens.
There's a question on FD rollover. So basically, majority of the FDs do get rollover, and we believe that this trend would continue as well. So what we've seen is actually with rates being high, we saw a shift from FDs into CASA, and with rates coming down, we will see some of these funds moving back into CASA as well. And our focus is on how we drive total deposits and mainly focusing on CASA.
There's another question on vehicle imports. What do you think about lifting vehicle? I mean, we are optimistic, cautiously optimistic, and I think the governor, central bank has already indicated that the countries or the VOP situation is conducive towards lifting of this ban. It's up to the government, the fiscal authorities to make that call. Of course, we are cautiously optimistic, and if that happens, prospects for HNB Finance, yes, goes without saying, it will be positive. Tier 1 capital, yeah, I think Priyanka did mention in her presentation about the capital position and the buffers we have. We are very comfortable with our Tier 1 total capital ratios. So there's no immediate requirement for us to really raise, come to the market and seek Tier 1 capital. Yeah, so I think whether we would want to lock in, the question is about, again, the bank alpha, whether we would like to lock in dollars given the rupees outperformance in 2024 so far. Well, I mean, yes, rupee has outperformed, and we might see a bit of pressure on the rupee if the vehicle ban is, lifted. But taking a position on the dollar, looking ahead of the transaction is not something that we are considering at the moment.
There's a question on the dividend policy. So dividend policy of HNB is to pay out 25 to 35%. Anything outside this range is at the discretion of the board. So in terms of the segments that contributed to the incremental growth, I think all segments contributed. So mainly we saw growth coming from SME micro, and on the retail side, we saw despite the vehicle importation ban that is in place, we saw the leasing book growing, housing book growing, cards, pawning. So the retail segment also we saw growth coming. Are there any further questions? So if there are no further questions, thank you very much for joining our third quarter update call. We look forward to talking to you at the end of the fourth quarter. Thank you very much.